Was that the blow off top that's going to wreck the bull market? I mean, was the earnings gap up just a big bull trap? I mean, personally, I don't think so based on the technicals, but of course, the bears will cite that the labor report revisions, the updated tariffs, and even the possibility of war with Russia is going to be the end of the world, markets are going to crash and burn. So perhaps instead we should label this as a bear trap, because just remember, we do get about 7 3% dips a year, and the low of Friday was almost exactly that. If we go to the 5% figure, there's two beautiful reference points that can act as support. I'd be much more interested in buying and not selling. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off today on the SPY monthly time frame chart now that the July bars have officially closed, and of course it's the second candle in there. So the candle in question is a solid green-bodied bar with just a little bit of an upper wick, indicating some pullback from the all-time high. However, where did we close? We still closed in the upper third of the monthly range. There's really no lower wick to speak of on this candle, so structure is bullish. If we're thinking about location on the bar-to-bar count, certainly a meaningful higher low, as well as a higher high, and the candle close is officially outside of and above the previous month's range. So all things considered, candle by candle count is absolutely in the bull's favor. If we're thinking about the overall trend here on the monthly time frame, we have lows. We have a major higher low here. Of course, this is a high, this is a higher high, and this is the highest high in the trend count. I know this might seem redundant, and we talk about this all the time on the monthly. However, if the monthly chart were to pull back from the highest high in the trend count, of course, the monthly chart could seek some kind of higher low and preserve the uptrend that we're ultimately in. Just as your general once-a-month reminder, if we scroll back to the Great Financial Crisis, you can see the double top, and you can clearly see the lower high that happens here, the break of the neckline of the double top, which offers a lower low, therefore the monthly trend is down, and then really bad things happen in the market. You can go back to not the Great Depression, but rather the dot-com bubble bursting and see the same exact thing. Here's your monthly double top, here's your monthly lower high, here's sort of the neckline-ish of that double top. Once you break to a lower low, the monthly trend is officially down. Here's wave 1, here's wave 2. That's when really bad things happen in the market. So if we're thinking about monthly downtrends as being the requirement for, oh my goodness, markets are going to capitulate and go to zero, you don't really have the opportunity for that to happen now that you have a higher high. It's not even a double top. If it were to turn into a higher high double top, something that would look kind of like this, where's the neckline breakdown? I mean, not to get crazy, but you're really asking for a break back down underneath about 480 if that's going to capitulate and flip into a lower low. I would think that the odds would not favor that for the month of August. Now, of course, the trendline traders out there are going to come back out from the woodwork and say, ha, I told you so. The resistance trendline is going to work this time. That's fine. And, of course, there is technically a resistance trendline there, but we've covered this in a number of videos now on the channel. The trend line is the trend line is the trend line, and it might work for a little while, but historically, these have a horrible win rate. So my preference would just to be watching the short-term, price action. Is there bearish price action here? So if the monthly chart looks fine and has an opportunity for an uptrend to continue, let's see if a monthly pullback will develop by going to the weekly time scale and whittling it down. On the weekly chart, let's talk about candle structure and location. What do we see here? In terms of the weekly candle, it's absolutely bearish. Check this thing out. It's a solid red-bodied bar, very weak, closes extremely weak towards the lower third of the range, almost smack on the lows of the weekly range here. And also, so structure's bearish. If we think about location, though, on the bar-to-bar count, notice that you do have a higher high as well as a lower low, so it's a bearish engulfer, and the close is completely outside of and underneath the previous week's range. So bears actually go 2 for 2 on the weekly count, bar to bar here, which is a change in tone. We have not seen this for the last month and a half or so. I wouldn't even consider these red candles up here all that alarming or similar to what we're dealing with right now. This is a clear character change, and it's probably worth paying attention to. Now, if we think about the overall trend, though, on the weekly time scale, we know that we have lows, higher lows. This is inherently a higher low based on the gap up there. This is a soft higher low. The daily chart really went sideways here. It did not flip to down. So is it possible that pulling back from the highest high on the weekly trend count, it's plausible that the weekly also seeks a higher low just like the monthly chart? Absolutely, and we've been talking about these two reference points until we've been blue in the face for the last at least 4 weeks as these green bars were printing back here. It's the previous all-time high around 613. And if the market overshoots that on the weekly time scale, we also know that these upper wicks from the two red-bodied bars back here could also act as support, which is closer to about that 604 level on the daily time frame. We'll see that with a little bit more clarity. So is the weekly chart in jeopardy of reversing the trend and, oh my goodness, the market's going to crash and burn and go to zero? I think the answer is absolutely not. Now, of course, if we pull a fib from the bottom of the tariff moves up to the new all-time high, we're well above the fib 38.2, and this is just a great reminder to reinforce that from the April lows, the markets are up substantially. And even if we were to pull back, again, weekly chart, monthly chart wise, there's absolutely going to be bearish trades to take on the intraday, or maybe as small swing trades, so to speak. But if we were to pull all the way back to here, from this Fibonacci perspective, measuring the move from A, tariff lows, to B, brand new all-time high, markets would remain in bullish consolidation over the top end of sort of, this is the that's the China deal to make a deal gap up back when we were resolving tariffs in the first place. You can see the weekly 50 SMA, the weekly 20 SMA meeting there for confluence as support. Again, I'm absolutely acknowledging that to get there will be some bearish pressure, but it's bullish on the very high timeframes here. Something that might be a little bit more useful into the upcoming week is some Fibonacci that would look like this. And I love this because if we look left, what does that coincide with? The previous all-time high here. So bullish consolidation over roughly that 614, technically the level 613. As long as we're above that, it would satisfy the measurement from, you could say, the gap up low to now the new all-time high as well from a fib perspective. Let's come in here with the anchored VWAPs on the weekly as well and see what that's sort of telling us. This is just confluence right at the bottom end of this zone. Again, that's the 38.2 from point A to point B here. So this is beautiful confluence around this zone. If the market were to pull back sort of towards this all-time high retest, lo and behold, the gap up anchored VWAP might meet us there for a technical area of support. It's probably not going to become much of a shock here if I throw on the volume profile, and we can see that generally this is the beginning of the high volume build out, right? It's not much of a shock. Why? Because of course that's where all of this volume commitment really starts. So if the market pulls back, fills in the low volume void in here and builds out some volume structure, guess what? This shelf is basically exactly where you would seek buyers stepping up. So all things considered, I don't really see a reason here to be overly aggressive on the bear side on the higher time frames. Now, of course, as we drop it down to the daily time scale, this is where things change a little bit. And once again, we've acknowledged that there's a change in tone. Obviously, the market has not really fared well up here with multiple gap up attempts being faded every single time we moved into that all-time high territory. The daily trend, as you can see, has left a nasty gap here, but like, hang on a second, let's pump the brakes and let's just talk about our typical stuff here when it comes to analysis. Let's not get what's considered HBS, you can use your imagination, really excited bear syndrome. Let's go ahead and just evaluate weekly expected move. You can see that's this box here. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. But generally speaking, the expected move is offering some semblance of a lower high here. This is 635.07 on the possibility of the upper bound, and the lower bound is down here at 608.37, implying a lower low underneath last week's Friday low as well. So admittedly, the expected move is bearish. Okay, we'll take that as a first data point. But what is the daily trend? Is the daily trend up, down, sideways? You know, on the Wednesday midweek market update, we were sort of talking about how this gap up was instantly going to provide a new higher high in the daily trend count, and therefore the trend probably remains in the upward direction. Now, Friday's breakdown actually overshoots a number of key reference points. The first one just being this, right around in here. The other one would have been the daily 20 SMA, which was at the lower edge of last week's expected move. So does this change the trend to down? I wouldn't say it's definitively down here on the daily time scale, but there's absolutely an opportunity to neutralize the daily trend. So remember, monthly trend is up, weekly trend is up, daily trend here is starting to neutralize via lows being equal to the bottom end of this balance range from back over here. Put yourselves in the shoes of a buyer, right? And you can easily do this if you watched last Wednesday's update. Clearly, up here, we were looking for anything that remained over about 634.65, give or take, this zone right around in here, the bottom end of what was at the time, Thursday, Friday, Monday, Tuesday, a 4-day balance range. As long as we were over that, we would have yielded a daily higher low relative to the Wednesday breakdown low. Obviously, that didn't happen on Thursday via the bearish engulfer that happens here. So that's strike one. Okay, not getting a higher low there. Strike two is that the gap down on Friday actually goes to the top end of the balance range, and that gap down gets follow through in the downward direction instead of offering a gap close, which would have moved in the upward direction, yielding still from here to here a higher low. So once again, acknowledgement on the daily timescale that the trend is starting to shift back to neutral via the equal low relative to the balanced low back over here. Now that we understand that, we should probably keep a much more open mind to trading both directions in the S&P S&P 500. Up here, it made much more sense to try to lean into the long side, and now that the trend is neutralized, we want to be a little bit more open-minded to trading shorts. So what's the game plan here based on the daily trend count and the structure? Well, of course, any consolidation in this box probably yields a neutral market. I would not be in love with trading inside of this zone here. Personally, the trades I would think are most lucrative are coming up for a gap fill reversal, setting a lower high. So if you're bearish, what you want to see is this, some kind of lower high here, and that then develops what? Of course, the classic pattern would be some sort of head and shoulders. Underneath the neckline probably yields the deeper pullback into the weekly level that we were just talking about at 613, and then beyond that, it's probably all about the ceasefire gap down here, which closes down around $600.50, and if you were paying attention on the weekly time scale, that would be close to the upper edge, or I should say the upper portion of the red inverted hammers, the two back-to-back red inverted hammers on the weekly. We were just talking about around 604. Technically, the ceasefire gap starts at 603.45. Now, in the very beginning of today's episode, during the introduction, I was talking about the depth of the pullback here. If we grab the measuring stick real quick, you can see if I come in from the high, the all-time high, to the low of Friday, not the close, but the low, this pullback has been about 3.25%, right around in there. If you extend this and actually move this into the 613 weekly high, doing something like this, you could start to see how that's 4.24%, which is not quite that 5% pullback. So this is an undershoot of the 5% pullback. But if we go to the ceasefire gap, it's a little bit of an overshoot of that level. So the main name of the game on the higher time frames, and I'm talking about longer term investment accounts. This is not just like a blindly buy it for a swing trade because why not? Longer term investment accounts, it probably makes more sense to me to try to add to your long-term positions at 613, previous all-time high retest, or something like a ceasefire gap fill reversal down here, seeking some kind of upward action. If you were looking for more confidence, you could try to play it as this higher low back above the previous all-time high. So all things considered, yes, there's a bearish change in tone. It's definitely not as bullish as it was now that Friday's session has broken down more meaningfully under the daily 20, underneath the top end of the balance range here. However, I still think there are reference points that I would be interested in buyers stepping up at to get confidence to trade for things that look like this. If we ultimately do, let's just play this one out as the bearish situation as follows. If we do this, I mean, I'm still interested in trading this path here, this path here. There's probably a reason to look for some kind of short underneath the neckline here to get to the ceasefire gap, or at least 613, right? These ideas are all on the table now, and I'm more open-minded to actually shorting intraday for the moves in the downward direction based on the developments from what we have on the Friday session. Let's actually go to, we'll go to the hourly chart to do this. What I want to talk about is just the concept of the gap down being a gap and go on Friday, right? We sort of touched on it a little bit as we were saying that the gap was right into what would have been a critical area of potential support to offer the higher low. What I just want to point out is that an unfilled gap like this typically indicates a little bit of bearish momentum, right? On the way up, we were talking about a lockout rally. These are sort of shaded down here. This is the EU gap. The China gap is underneath us beyond that. So China gap here. This is what remains at least of the EU gap tariff deal here. This is the ceasefire gap up. There were a number of gap ups here that did not close. That indicates upside momentum. If the market's going to change its tone, unfilled gaps above us start to indicate that stronger sellers actually are starting to step up in the market, and it's not so much just profit taking, in terms of long positions being sold. So this could be the initiation of new money sellers getting active in the market. Now, I don't necessarily see that in the market internals, which we'll get to in just a moment, but on the hourly time scale, I do want to give you guys a little bit of a stronger semblance of pathing instead of just talking about like, okay, the general ideas. What would be the pathing idea early on in the week? So as I was saying earlier, I would mostly be interested in the possibility of a rally rejection here that keeps the gap unfilled, targeting something like 618.50. If that's the case, then we absolutely have a lower high happening from here to here. This would be an equal low. If we're in an hourly downtrend, possibly flipping into a daily downtrend, a break of the neckline opens the door for the weekly level at 613 like this. Do keep in mind that the daily 50 will offer confluence around that level as the week wears on. So this is maybe pathing idea number one. Pathing idea number two is I would be very interested in taking the long to close the gap overhead. Very interested in this possible buy right here over Friday's high. Friday closed well underneath the lower edge of the weekly expected move. Inventory is massively net short here. If we can get sort of this move up and over the balance range high again and into the gap, I would love risk reward that plays out along these lines right here. When we get to the gap fill reversal, as we mentioned on the daily, the first thought should be, okay, let's not forget that this is overhead supply, it's very possible that even after the gap close, you're looking for a little bit of a rejection there. And I would really, really encourage you to pay attention, if this is the path that unfolds, to this balance range high again at 626.65. If this is going to act as a daily lower high, the market's going to have no issue breaking right back down through 626.65. If the market struggles here a little bit and starts to actually offer one of these, please keep an open mind based on what we just talked about on the monthly timescales, based on the weekly timescales. This is going to be the trade that just absolutely ruins bears, right? If this starts to step up as a higher low, I think it's game over. I think you've achieved your 3% pullback or whatever for the third or whatever time this year, and now we move along from this acting as a higher low, trying to navigate back to the all-time high. That would be something that I really would encourage you to pay attention to at the 626.65 based on the higher time frame trends, right? There's really not all that much of a big tone change on the very high time frames. It's the small time frames where things are just starting to get a little bit shaky. But remember, if the weekly chart is going to offer a firm higher low, the daily trend needs to inherently flip to down. It's okay to get a daily downtrend if the ultimate goal is to accomplish a weekly firm higher low, pulling back from the highest high, which is ultimately what this market is doing. Now, if this upside path does not play out, if we do not come in here to, either test this and then rotate back to the downside, if it's just straight lower off of the opening, Monday session or something like that, consolidation or any bearish acceptance under 618.50 is going to be your key. If you're below that level, all of this balance, or breakout, I should say, is going to look like a failed breakout in hindsight, and this now will act as overhead supply, where buyers who are involved in positions here no longer feel like this, probably want to get out for break even, and thus will sell this low at the first chance they have. And therefore, what's the target? As we've already talked about on the higher time frame, 613, when and if we get here, acknowledging that this would get me back on the bull side of the market. This would act as your weekly higher low off of the previous all-time high, 613. You gain more confidence back over 618.50, and then you're back up to really attempt to close this gap as your first major target. The threat for a lower high would still exist here if we have not closed this first and we're attempting the weekly high and then moving higher. Okay, you could fall into a weekly equilibrium if this does then yield a lower high in the future, but please, let's take this one step at a time. What's in front of us right here, right now, for Monday, early on in the week, is some attempt here, and then a pullback to here, right? Reevaluating at that level. If we break and go through, we're talking about 613. First thought is something that looks like this, building confidence back over 618.50. If we do something that looks like this, gap fill reversal is the first thought. I would really tend to side with this, being where I want to get back on the long horse, trading the all-time high. If we do move through with a lower high back in range, I would start to trade this back to the downside and then look for the follow through, noting that this would be your lower high, right? So in the dotted path, this turns into a lower high. The final thing that I'll talk about here before throwing on the anchored view apps and the Fibonacci's, we'll pull a couple of those, is you can see up here I've got this overnight all-time high marked out. The auction did not end properly at the all-time high. The all-time high was actually set in an after-hours session, which typically does not hold as the tippity top of the move. Typically, you need an excess high in regular trading hours, and we didn't get that on the Thursday session. Yes, we gapped up, but the overnight high was actually higher than that intraday high. So it's something to carry forward. It doesn't mean that the market needs to go there tomorrow or on Monday or Tuesday, Wednesday, whatever. It's just a weak reference point where if the market does tend to trade this path here, it is a target that I would have in mind as being reasonable, thinking that the market should try to go up and repair it, right, if the market's trending higher. So these are the base cases. Of course, this one, as we've mentioned in here, also kind of interesting with the opportunity to turn into this guy, as we've talked about. If the market starts finding acceptance underneath 613, that's where the ceasefire gap really comes into play a little bit more so. So much more open-minded to many of these paths unfolding. I think you've gotten the gist of my tone here with the change in tone literally from the market based on Friday's gap and go. If we pull a couple of Fibonacci's, let's just see what we get into. Well, obviously from here to here, that's a 100% retracement. If we come in from the high, what do we align with relative to the fibs there? Look at that. I mean, you can't make this stuff up. The Fib 38.2 right at the balance high, reinforcing that 626.65 is absolutely a key level. From this perspective, it sure is bearish consolidation. If you're just rallying, rejecting, staying in here, once again, the 613 target becomes very optimal. If we're going to close the gap, it's the 61.8. That's usually a line in the sand. As long as you're below that, the bears would maintain some sort of edge when thinking about the move from point A to point B. However, if we were to get over that level, right, something that closes the gap, pulls back, and then goes here. If you're over that Fib 61.8, I know we already talked about it from a levels perspective, but over 631.50, buyers back in control, and being over the 61.8 dramatically increases the odds that you do see that 100% retracement to which in this case would be the all-time high. Let's clear that up. Let's throw on the anchored VWAPs intraday and see what we can see from this perspective. I've adjusted these slightly. So you have your all-time high anchored VWAP. You have this from the breakout. You have this from the original balance range back here. And this is the ceasefire gap up day here. Notice that we're now underneath the entirety of the stack, which was different from what we were dealing with on Wednesday when we were still up here above everything in the stack. So that's a big change in tone. I think it's noteworthy that the all-time high anchored VWAP will offer confluence here at the 626.65. So please do carry that forward. Let's get a little bit more granular now and start taking a look at the market internals. If you're not familiar with the market internals, check out the video tutorial in the top right-hand corner. What do we see here? Well, on the Friday session, you absolutely have substantial volume outflows. You got pretty close on Thursday. Generally speaking, I think the Wednesday was a little bit of an overreaction based on the Fed, but these two definitely indicate, once again, a little bit more of that change in tone. If we're thinking about the advanced decline line, it was not bad on Thursday, and I was honestly going to give the buyers the benefit of the doubt if on Friday we opened inside of Thursday's range. It just wasn't the case. Obviously, we gapped down. One thing I do find a little bit interesting is that the advanced decline line did not move into trend lower zone here. I'm not trying to say it's bullish, but it's not as bearish as it could have been. If we're thinking about the index score, no surprise in here with 2 down days and trending down days at that. We do see a negative double-digit index score there. And the tick on the cumulative, honestly, another one of these things, I'm not going to say it's bullish. Please don't misinterpret what I'm saying, but it's not as bearish as it could have been. You don't have these beautiful 45-degree lines building out on the cumulative, which would just indicate that at the exchange level, there was a fair amount of two-sided trade here. Right? It's not like the sellers dominated everything intraday. When I say everything, I'm talking at the exchange. Every single stock was clearly not downticking. Otherwise, this would be spending much, much more time in these lower zones. So as I think about the nature of the way the market's moved lower here, as I think about the opportunity on the higher timescales to want to be a buyer around 613 or want to be a buyer here around the ceasefire gap close, I'm very interested in that so long as the market's not getting totally brutalized at the exchange level, which is kind of what we just saw here at the market internals. Yeah, the volume flows were out, but not as bad as it could have been, not nearly as bad as it could have been here. I'd be curious, and obviously I know what the data point is already, but breadth, it did somewhat contract into the end of the week. It's not really a shocker, but we'll take a look when the time is appropriate. Let's move on over to the market profile. If you're not familiar with market profile video tutorial for you, in the top right-hand corner, what do we see here? The most notable thing is that on the Thursday session, value was somewhat lower, right, relative to Wednesday. Here was the FOMC, the low of FOMC. We made note in the Wednesday midweek market update how, hey, would you look at that? The value area, even though the FOMC breakdown was pretty volatile, the value did not shift lower. On Thursday, I would argue that value being engulfing here, it's over and under, that was why I was willing to give buyers the benefit of the doubt. If we had opened in range on Friday, we clearly did not, and value thus has officially shifted lower much more meaningfully. One thing I'll call out here is that there's not really a great excess low in J period from that Thursday session. So if the gap closes, I would count that sort of towards repair on that move. There was also a single print string, if I'm not mistaken. Where was that? I think it was. Maybe I'm mistaken. It was probably the NASDAQ. We'll look at the NASDAQ momentarily. But relative to the Friday, end of day, take a look at this. There's beautiful taper, beautiful excess on that J period low. Value area, again, it's lower relative to what we have off to the left. Point of control, not slammed down towards the low. So I'm a little interested in seeing where we open up on Monday and whether or not, as we were saying on the Spiders Daily, we did close underneath the lower edge of last week's expected move. If this is an overshoot and inventory got too aggressive on the downside, is it possible that the counter trend move happens first? I would think yes, and then it becomes all about that 626.65. So if you said, excuse me, you have to pick a pathing idea that you think is primary first, I would tend to think an open in here, rally, and then some sort of test of this 626.65 is the primary situation. All right, so that's what we've got out of the S&P. It was a lot. We had a monthly close. There was a lot to unpack with the possible change in trend here, but you guys know my thoughts. Open-minded to more two-sided trade. Not going to be as firm on the bull side in here until we start getting into some of those major supports coming from the higher time frame, really being open-minded to longs off of these levels in the higher time frames. But to get there, absolutely more open-minded to trading shorts and looking for those rotations to the downside to get there. If we do move higher, again, not a problem. 3% pullbacks do happen frequently in the market. If the market recovers, no problem whatsoever. We'll get right back on the bull side. Let's take a look at the QQQ. Let's keep it a little bit more brief because, of course, there's going to be a lot of overlap in the way that these charts look. We'll point out any of the major nuances, but we'll try to save you a little bit of time here in the Saturday update video. Let's go ahead and turn off our drawing set. So on the monthly time scale, candle structure is the same. Bulls have control there. Higher low bar to bar count, higher high, close outside of previous month's range, bullish. If we're thinking about these previous highs, monthly could easily yield a higher low above that. If the monthly pulls back deeper than that, no problem. I would probably be interested in the origin of the tariff breakdown, this kind of area in here, which is just shy of about, well, actually, it's right on at 510. I was going to say it's just north of 500, but hey, what's 10 points between friends on the NASDAQ, right? So 510 would be sort of, let's just take a look. Why not? Let's take a look. Let's break out the Fibonacci's on the monthly instead of the weekly. Yeah, look at that. Right around the Fib 38.2. That's a pretty solid look. On the monthly chart, if we were to pull back to here, easy opportunity for a higher low. Monthly trend remains up. No reason to be a big mega bear. Let's go ahead and clear that up. Let's go on down to the weekly chart. Let's see what we have here in terms of candle structure and location. Forgive me for the cough. We do have a bearish engulfer, so rinse and repeat the commentary from the S&P. Your previous all-time high pullback level is in here, just north of 540. That's 541, I believe we'll see on the daily chart in just a second. If we pull back and hold that, beautiful opportunity. It's also better confluence with the upper bound or the upper portion of the range from the two back-to-back inverted red hammers over here. If we bring out the Fibonacci, since we've already come in from the tariff lows on the monthly, let's just come in from the gap up from the China deal. The 38.2, just like the S&P, it is offering a possible higher low, but it's above the previous all-time high. So just calling that out there. Small discrepancy. The 50% is much more on the money. Generally speaking, as long as we're over the Fib 61.8, excuse me, we are all set, and I would not be, again, a mega bear on the weekly. If we're thinking about the trend count, lows via the gap up, soft higher low, this could easily yield a firm higher low if this pulls back, which of course it's starting to do. If we go ahead and throw on the anchored VWAPs on the Qs weekly, just making sure. Yeah, we get a great deal of confidence in here around that 505, slowly creeping up for the 510 confluence we were just talking about on the monthly. You can see that this is going to meet us right here at, of course, the previous all-time high. This anchored VWAP, if we throw on the volume profile, which is weekly volume profile, there we go. Let's auto zoom that. You can see over here that the high volume shelf, of course, is right in this zone. So as and if we backfill this low volume void, let's accumulate some volume here. If buyers step up, it would make sense from a volume point of view as well. If people are trying to defend any positions that were put on here or any positions that were put on here prior to the breakout to brand new all-time highs. Let's drop this thing down to a daily time scale. Let's take a look at the QQQ on the daily. How deep was the pullback here? We'll start with that, and then we'll get into the weekly expected move, so on and so forth, from the high down to the low of Friday. It's looking like about a, what do we have here? 3.96. Why did that not take? Let's try that one more time. There we go. Click, click. There we go. About a 4% pullback. Let's just round off and call it about 4%. So 4% brings us to the bottom end of this balance range from here. If we go ahead and activate this trend line, let's go ahead and bring this towards the top end of the ceasefire gap. That's about 6%, a little bit deeper than the 5. And the previous all-time high level, right around in here, 641, as we were saying, is about 5.8%. So a little bit deeper than that 5% statistic we were seeing in the intro, but it's only that. It's just a statistic. I would always opt for some kind of structural reference point and not an arbitrary made-up number. Oh, 5% sounds good, right? It's just a stat. So as of right now, daily trend and weekly expected move. You are dealing with the possibility of a lower high, just like the S&P. That's 566.99. You could round up if you'd like, 567. That's a lower high and a lower low, of course, down here at the previous all-time high. The lower edge is technically at 540.77 if you want to be precise. In terms of the daily trend, a little bit more damage here on the QQQ because you can see, although it wasn't a firm hourly downtrend, I would call this a soft higher low. You are ultimately underneath that and trading into the equal lows of the major equilibrium from back here. So higher high to a lower low is technically a broadening formation. I'd have to remain neutral until ultimately some kind of firm lower low underneath here, because remember, this is soft. It wasn't really a firm hourly downtrend. I'm hard-pressed to say that we're officially in a big-time downtrend here. But if a lower high were to emerge, that could either be at the bottom of the gap, it could be the gap fill reversal, just like the S&P. If a lower high were to emerge, then of course, we'll start to acknowledge the change in trend. And once again, like the S&P, you could probably make some sort of twisted argument for a head and shoulders as follows. So therefore, your neckline and your key inflection point is likely going to be 551. If you take that out, I would be a little careful through here. This honestly deserves, let's go ahead and do this together in real time. That's going to get dimmed back to a dimmer gray line. I would think that this kind of breakdown here should yield the full test of the previous all-time high, which is closer to that 541. At this point, you would have a bunch of overhead supply from this advance here. Lower high underneath, once again, 551 could accomplish that deeper pullback. If the ceasefire gap is going to fill, you're probably looking at a Brigade bolt that needs to accept below. I wouldn't just be short on the smack on the lows here. I would look for the retracement and then the move into the lows, right? Being short on the NASDAQ is... it can be lucrative if the market actually has momentum, and perhaps the market will gain momentum if we get there. But as of right now, it's still not quite all the way there. And I'm sure the bears of YouTube are probably going to be like, oh, this guy's never going to give it up. He's just going to be the perma bull for forever. I don't see the argument for this being anything more than, as of right now on the higher time frames, a little bit of a correction, a little bit of a pullback. It's hard for me to say that this is going to develop into an equivalent of what we had back here. And if you recall some of the weekend videos from when this trend did flip to down and this lower high was in, I was, you could go back, you can find the videos just before April where I was saying, hey, watch out, lower high, 200 SMA, no good. This is going to be, a big test. I was bearish. So I will flip more meaningfully bearish when I have to be. But on the daily chart here, yeah, the gap and go, we're still over key reference points. I think for me, the main thing would be if the weekly chart does not offer that higher low over 513, mixing my Qs in my S&P. 541, not 613, 541. If we don't hold there, then on the higher time frames, I would be changing my tone to more open-minded, to more aggressive downside. But for now, I would think that the idea, let's go to the hourly chart. The idea here is, we'll be open-minded for this short. We'll get back down to the equal lows. We'll be open-minded to trading both sides of the market. But is it like, let's overstay our welcome and knock this thing out of the park? Probably not. Probably not. I'd be a little less interested in trying to close this gap above on the NASDAQ versus the S&P 500. The S&P seems to be a little bit cleaner to me overhead. This is a big, bad, choppy range back here. So I would sort of steer clear of that. You've got 558.85. It's technically a trade when and if we get here. Same thing as the S&P, sort of looking for that reversal. Let's call this one a double top. That's fine. Back underneath 557, probably rotates 551. If this is under 551, that's really where I think the better trade unfolds from, let's just call this A to B, right around in here, right? And so therefore, it's probably going to be similar, where if you just do this, you're probably looking at that A to B move anyhow. Remember that at this dot right around in here, it's more of a circle, it's a zone. Be very open-minded to the reversal back to the upside. That would be bullish, holding on to previous areas of resistance, now acting as newfound support. So that location, like all of these levels, these locations that I'm pointing out here, are the things that I'm mostly interested in. I would think the upside is the first reaction as well, just understanding the reaction from every single time the market was back towards these levels. Buyers stepped up with a vengeance, and as of right now, like I've said, higher time frames still support buyers being in control. Maybe there's a little bit of a tone change here, but the first thought is to at least test the Friday high, the daily 20. If we fail it, then fine, right? That's fine. A retest here probably brings the equal low breakdown, but just expecting that the market's going to fall off of a cliff and do this immediately, I'm not overly thrilled about that as an outcome. I would find it probably very difficult to trade that, another gap down here. I would tend to want to see a gap fill reversal if we do gap down for Monday to do something that looks like this, right? So that is the QQQ. Those are the levels. Those are the numbers. We've been pretty clear about how the pathing develops, probably similar to the S&P 500. Let's jump into our intraday anchored VWAPs. You can see we're under the majority of the stack. If anything, this is reinforcing that 557, which is the top end of this balance range from back over here. If we get back above that, seeking the gap close. If we fail and just stay in this range under all the anchored VWAPs, as we've talked about, probably looking at lower highs under 551, daily 50 SMA, previous all-time high, 541 as your big bad test. If we pull a Fibonacci from the high to the low of this move, do we get great confluence like the S&P? Not quite. Not quite. Fib 38.2 is close to the daily 20 and the anchored VWAP cluster. It's not quite the top of the gap at 558.85. The 61.8 to me is a little bit more meaningful up at this level. Again, you can put yourself in the shoes of a buyer headed into the end of the week. Technically, the gap up on that Thursday session, it should have yielded, and should have is always a subjective term. The market can always do whatever it wants to do. But if we're thinking about this from a trend and a framework perspective, the best outcome for buyers is a gap and go, obviously. The next best is a gap partial fill over the Tuesday high. The next one is a full gap close over the Wednesday high to then rotate for a higher low. The line in the sand is here at 566. So did any of those things happen on the Thursday session? No, which is why we're sort of acknowledging once again there's a little bit of a tone change here. And Friday confirms that via the gap and go. So open-minded to trading that downside here off of these upside reference points. I think we are going to... We'll see what the Monday open has for us based on a gap up or not a gap up, a gap down or an open in range. Let's move into our NASDAQ internals here. See what the NASDAQ has for us. Much more severe volume outflows. We shouldn't be shocked by that, considering the weakness in semiconductors, which we'll get to. There's a lot weaker of an advanced decline line here, and notice that the cumulative build is also much more bearish. So why is this the case? Because as we all know, the sector rotation keeps the S&P 500 a little bit more broadly balanced versus the concentration in the NASDAQ side of things. So keep an open mind that the NASDAQ could have some relative weakness if the concentration continues to be an issue. Now, of course, this cuts both ways. If this is over-correlated to the downside, which to me, it certainly looks that way on Friday based on volume flows, and more importantly, the advanced decline line, it would not be unreasonable. This is why I was talking about inventory being overly skewed net short. It would not be unreasonable for the market to try to close the gap overhead, to try to correct some of this overly net short inventory where everybody sold everything on Friday. If there's going to be nothing to rotate back into, counter trend move is not unreasonable. If you see a bloodbath on Monday, that's just going to be a pure play signal. Hey, it's sell everything, and anything red from the open straight across the board here, sector-wise, is going to tell you that there's nowhere to hide. If there's little spots of green, just a handful of sectors are green, then it's going to indicate some degree of rotation. And once again, I would think that this inventory correction would need to take place, and maybe tech does get bought up on the Monday session, right? This is still within the realm, let's not forget, of a reasonable pullback on the higher time frame weeklies, still well over the previous all-time high here. So with that, we can jump into, into the market profile for the NQ. We are looking at the NQ. Is this on me? Did we totally gaff that? I think we did. We must have gaffed that on the first look at the S&P. Well, it doesn't really change much. You can see that you have a distribution here, good excess in the J period low, A period highs. That's on me. This is not a poor low on the Thursday session. That's notable. It is a poor high. You could see the overnight all-time high that has not been repaired up here. That's the S&P. So I guess we'll clear that up. Let's go back over to the NASDAQ, which, unbelievable. How did I not notice that? Regardless, it's the same commentary. You don't have a poor high on that Thursday session, but you do have the overnight all-time high that is unrepaired up there. So that will act as a target. Your value area was lower. We already heard the commentary on the unbeknownst to me NASDAQ read. So with that, we'll save the time. We'll go back on over to the platform here. Let's take a look through our IWM small caps. Let's see what's going on with the smalls on the monthly time scale. Let's kick it up here and let's grab, multiple years. I got the infinite excuse on the cough in the Discord chat the other day. So I do appreciate that. I'm excused for infinity. Previous highs, previous lows of the April tariff move. Obviously, you can see here the threat of a monthly lower high that is different than what we've seen on the S&P and the NASDAQ. And for that reason, have to keep a little bit more open mind to just being neutral on the higher timeframes for small caps. And for that reason, you guys may or may not know, it depends on how long you've been around the channel, I don't actively trade or invest in small caps. I'm much more, well, maybe some of these things fall into the small cap category in the speculative side, but I'm much more using this as a bellwether gauge for the market all up. So if this is actually yielding a lower high, it might make me a little bit more neutral on the S&P. Not, oh my God, S&P is going to crash and burn, but just something to carry forward. I think the biggest thing here is that the candle structure is different as well. Much larger upper wick here, closing the 50% of the range. Still do have a bar-to-bar higher low and higher high close outside of range, but the upper wick is a little bit more substantial. And the reason that's important is because this, on the weekly chart, probably solidifies a little bit more as a head and shoulders, but it's right there. We're right at the cusp of breaking down through this neckline. So let's just go take a look at that actually on the weekly, and we'll keep this thing moving along. Here you go. Here's your left head and right. There's your neckline right around in here. The weekly bar goes right to it. It is under threat. It's a stress test right now. I'd be very curious to see if buyers can step up and hold that. If they do, that would be a bullish sort of tailwind for the S&P 500. So please keep a close eye on roughly about 215. I think I've been rounding off in previous episodes to like 217. That was a more important daily level, but the 215 on the weekly is A-OK in terms of just a round figure and a reference point. If we're above that, I would tend to be a little bit more optimistic. This is ultimately an uptrend, lows, higher lows. Is it possible that previous resistance acts as new support? Absolutely. And again, it's confluence with this previous level. If we come in here with a couple of fibs, there's three perspectives we want to take a look at. From low to high, 38.2 is well below us. This qualifies as bullish consolidation. From this lower high to here, we're still pulling back over the 61.8, so this would qualify as being bullish ultimately. The recapture would improve the odds of the 100% retracement. And then finally from up here to down here, you can see that we're actually breaking back down below the fib 61.8. So in a picture-perfect world, the market would get back above these previous weekly lows, closer to that 217 round figure I was just talking about, to improve the confidence over on the S&P 500 based on a fib perspective. If we clear that up and throw in our anchored VWAPs on the IWM weekly, we're coming into the cluster. It's kind of do or die zone. You know, I would hate to paint with such a broad brushstroke, but if this zone kind of holds in here, is it not the end of the world? Probably. You're probably doing all right on small caps. If you can just generally get sustained action here for some kind of monthly higher low attempt, you'd be in monthly range compression if that were the case, right? You would obviously have a lower high and some sort of higher low, and then it turns into a triangle. Everybody calls it out on social media, and oh my goodness, the break is going to happen in one direction or another, whatever. We're not there yet. As of right now, I would still maintain a slightly more optimistic stance on the higher timeframes based on this attempt and this trend that's developed higher here. It's not detrimental because we're not underneath the fib 38.2s from what we had in this zone here. This is not bear flag consolidation. With that, we'll drop it on down to, we'll go out to the volume profile on the weekly, and let's see what we get there. So a high volume node is acting resistant. Low volume void pullback sort of keeps things right around 210. That is kind of the low of last week's bar. So I wouldn't really want to see prices much lower than that. You could use last week's low as a line in the sand here. Let's go down to the daily. Let's get granular. Let's take a look at exactly what we're dealing with here. So expected move, first up, we do have 221.43 offering a lower high, and we do have this 208.41 offering a lower low equal to these lows from back here. Generally, this is overhead supply. We had talked about during the week that this was a balance range. There was really no trend. This is now definitely falling into an IWM daily downtrend via this acting as a lower low. This was high, equal high, maybe lower high here. You absolutely have an hourly downtrend. So all things considered, the IWM small caps are in a daily downtrend. And if the market were to close this gap overhead and rotate back to the downside, that would be a pretty detrimental threat here for the higher time frames. Remember what we were just talking about. You could use Friday's low as a line in the sand, but that 215 level, kind of more so aligned with this, is more appropriately where I would sort of take that over or under based on the neckline of the weekly head and shoulders. If we're above and closing the gap and staying above, maybe we have a higher low reference point relative to here, and we can poke back up into the box. This will turn into a look below and fail, and great, we rotate to the top end. That would certainly help the case for a bullish S&P 500. If small caps close the gap and roll over, and they're underneath 215, and they're testing Friday's low, suddenly this S&P 500 bullish narrative might go out the window just a little bit, and we could be more hell-bent on trying to get that full retest of the previous all-time high at 613, or even the ceasefire gap close, which was slightly lower than that, right? So that is your IWM daily. I do like the hammer structure here. I like the fact that buyers stepped up off the lows and did close prices over this previous opening print from back here. Would it have been better if the gap down didn't get follow through in the first place? Of course. Would have been best if we just opened here and rallied to close back in range. Didn't happen. We're trading the chart in front of us. For now, slightly bearish bias, staying underneath the overhead supply. 218.60 is that key level. Let's take a quick look at the hourly chart. We'll keep it brief here. A lot of the same commentary, something that looks like this to then reject 218.60s, rolls back over. I would really pay attention then to the 214.75 if we get this. Detrimental. If we do something that looks like this, let's say we close the gap, pull back, support for a higher low, and then Brigade bolt over 218.60. That's the bullish case we were just outlining for the S&P, acting as a tailwind to get back to all-time highs. If we do move lower first, and we're just underneath, Friday's low, or consolidating really under 214.75. If I zoom in here, you could start to see how these afternoon lows were trying to support higher lows intraday, here, and here. If you drop that, I think that you just have too much overhead supply. It's going to be very difficult to overcome, basically, and I would just continue seeking downside targets, right? So that is what we have there. Let's go ahead and, I guess to be congruent, we'll just throw on the anchored VWAPs, because why not? intraday anchored VWAPs. You're underneath the entirety of the stack. Even the beginning of the gap is going to be confluence with that Thursday move as well. This is not the high of the move, but still based on the volume commitment, that's really where it started to come in on that Thursday open. Makes sense to probably have an anchored VWAP volume, weighted average price tied to it. If we come in with the Fibonacci's, we could pull a couple of them. Let's start from this high down to this low. Yeah, 38.2 gap fill reversal keeps all of this as overhead supply. That's bearish. We could also come in from, I guess, just this high. It's going to be very similar, of course. Yeah, 38.2 is now confluence with the anchored VWAP in there. We could come in from this low. Oops, it's going to click. There we go. This low to this high. 38.2 here, which can now act as resistance, is all of the overhead supply. And here's your line in the sand at the Fib 61.8, which would unlock, if we spend more time below, 214.75, all the way the move to around roughly about 208. That's more damaging on the higher time frame. So that is your small cap look. Does not look great over here in smalls, I must admit. We know that they're more sensitive to the economic data, which we will parse out when it comes to what happened with the Fed, the labor report, the whole 9 yards. You could see the volume outflows on the internals. You could see that the advanced decline line was near, but not in trend lower zone, and a little bit more of that sporadic build on the cumulative, very similar to the S&P 500. I would say that the NASDAQ seemingly has the most damage at the exchange level, once again, based on its concentration. If we go over here, this will be the only market profile that we looked at in the correct order. Again, that is on me. What do we see? Well, the first thing I would point out is that the Thursday session did not even come close to testing the Wednesday single prints, right? Wednesday had this nasty bout of single prints here. You could see just how the value area and the volume point of control drifted underneath into the lower distribution versus the upper distribution. Look at the high of Thursday. You open technically down here, get a little bit of a rally, reject all of the single prints, and then close where? Weak down here, point of control migrates lower, value area is overlapping to down. It doesn't even get any shot at moving value into the single prints up here. I would definitely carry that forward as a bearish data point, right? On the Friday session, obviously value is a little bit more centered, but clearly lower from on the Thursday. And we do have a good excess low. Once again, that hammer in nature might suggest a little bit of a counter trend move first to attempt the gap close. I guess the bottom line, let's go back over here real quick. Bottom line would be, if we move into the gap and reject, I would just carry that forward for the S&P. If we're in the gap first, I would look for that upside rotation out of the S&P to sort of play nice with the overextended sort of idea to rebound back higher. But if we start rejecting this more meaningfully, if all of this remains overhead supply, if we cannot get over to 1860, that's your struggle point for the S&P. With that, let's go ahead and take a look at the sectors. Let's reset this back to a daily, nice and clean here. That's much better. So as this pullback has unfolded, what did the weekly performance of the sectors actually look like? Who was leading? Who was losing? Where was the weight? The TLT did outperform. That is a D for defensive rotation there, up 2.13%, followed by utilities, up 1.53%. Also defensive, also lightweight. Utilities are the most bond-like sector. If you look at the bottom end of the barrel, it's the materials sector, XLB, down about 5.57%, followed by discretionary, ouch. And then we have financials, ouch, down about 3.71%, healthcare down 3.66%, industrials taking a beating. But where is that XLK and the SMH? Don't get me wrong, they're still down more than 2% on the week, but they did outperform in a loose sense by being down less the actual index itself, which was down 2.47%. So all things considered, not really horrible as an actual pullback was taking place. The heaviest weight sectors did not lead the decline in the downward direction. When I say that, I'm really just, SMH is not a direct sector, but technology did not lead the decline there. It was definitely more associated with the discretionary sector and even financials pulling back. And if you've been tuned into the channel, the XLF chart has room for a higher low. Let's take a look at the TLT. There's a little bit of this range that's building out down here. If this double bottom is going to break out, that might be interesting. It could be time. And what I would be really interested in doing actually this week is if we get some kind of rotation to the downside on the TLT, I would maybe be interested in selling some puts down here at the 85 handle instead of trying to sell the 80 puts when we're breaking 85. So if this is now going to act as a double bottom, some sort of attempt at this, we all know that the odds shot up immediately on that Friday session after the labor report was released for the odds of a rate cut dramatically increased there. We'll talk about the Fed tracker tool momentarily. Any sort of pullbacks here in bonds could be a put sale underneath about 85. So I'll be watching implied volatility on the TLT itself to see if it's actually worth our time and we can pick up enough of a premium received. Here's the utility sector breaking to an all-time high. Is the market breaking to an all-time high at the same time? The answer is no, right? Obviously, we pulled back on Thursday, Friday, so upward pressure is upward pressure. It's keeping the rotation thesis alive, but it is D for defensive, and it's leading here, obviously. So, pullback is kind of A-okay. If we look at the XLB, it looks horrific here. However, I want to actually bring your attention to the XHB, which is something we've been using as a bit more of a proxy for the cyclical side of the economy. If you look at this, I mean, really hard to say anything aggressively bearish, if we don't break the neckline of this double top and the weekly double bottom instead remains in force. This is going to be like a weekly Brigade bolt over the neckline at $100.50. So all things considered, XHB, XLB, there it is, really disjointed. I would think that the materials sector moved substantially lower based on the move in copper, of course. HG are your copper futures, and of course there was the tariff on that. Let's go /HG there. And you could see it here. Boom. Probably more isolated to a tariff thing and less about copper miners, less about, obviously the price of copper is lower here. There's likely some trade to unfold, the reversion to the mean or something of the sorts, unless this is the reversion to the mean down here. I'm not a copper expert, not a commodities expert. I'm not going to try to pretend like I know exactly what the play is down there, but this, in my opinion, has much more of an influence on what the XLB is doing versus the XHB, which is directly home builders, right? You could, if you're like, no, use a different one. ITB, home builders, right? Still looks okay here over this level, if this is going to be the equivalent of your neckline. So all things considered, cyclical side of the economy is a takeaway there. Not all that bad. What is fairly bad, though, is absolutely this move here on the XLY. Take a look at that on the gap down here. Of course, thanks to Amazon to some degree. Just could not hold it together, and unfortunately, this is back inside of this balance range. So I do have to maintain now a little bit more of a pessimistic or bearish stance on the XLY, noting that if we're in range under 217.65, I would think that the bears have control. This is a failed breakout. This is overhead supply. Even if we close the gap, this is now a head and shoulders threat. If we're back in the range after closing the gap to the upside, I would have to think that the rotation is here to maybe test and close the gap to the downside. That's certainly a possibility. So XLY, definitely a headwind for the market. One of the reasons we're open-minded to some different different trades out there. So XLF was offering that beautiful opportunity, as we were saying, for the higher low up here. Obviously, it's broken down. It's more at the equal low. I'd be interested to see whether or not this can close the gap to the upside and then accept over 51.75. If it cannot, that would be more of a concern because the neckline break of the double top is right there, right? If we're underneath this, okay, now all of a sudden it doesn't look so hot. All right, so financials dancing on the edge. XLV, this sector is totally uninteresting to me. I think chasing UNH, Novo Nordisk, all that stuff, totally uninteresting. The sector needs to undergo a massive transformation before the narrative sort of becomes interesting as a trade idea or to build a thesis around. That day will come at some point, but if you're just trying to buy something like UNH because, oh my God, it's so cheap, it has to go back up to like, even if, if I could just get it to 400, that's great. You're playing a fool's errand. This has just done nothing but go lower, trapped overhead supply. At the bare minimum, please at least wait for a daily uptrend. Please at least wait for a weekly uptrend. There's just nothing to do on names like that. NVO is Novo. You can see it falling apart as well. Big downtrend here. The joke about this one is just like, okay, here's the Ozempic bubble. And unlike, just like the dot-com bubble crash, here is the Ozempic bubble crash. We'll see ultimately where that ends up going. But healthcare sector, I wouldn't touch it with a 10-foot pole personally. Let's jump back to the dailies. Here's the industrials chart. Plenty of room for a higher low in the higher time frames. Yes, the gap down. Yes, the break of the 20 SMA. The whole 9 yards. Look at the hammer, though, off of this level. Pretty intrigued by that. About 8% right now of the S&P 500. We'll see if this can sustain some sort of break over Friday's high to be upward pressure. Real estate moving lower here, which is kind of surprising to me, noting that the odds of an interest rate cut moved in the upward direction. I thought, didn't everybody want lower rates so that we could go out and buy homes? Well, you should be sort of, thinking about homes moving higher if rates move lower. So, to be I was being a little bit facetious because you guys know my stance has been a little bit more opposed to that massive cut of rates. I think that real estate reacting to the downside here on the labor report revisions and the premise of rates moving, I should draw a down arrow, rates moving lower, is more of a fear about the opportunity for, I guess, the consumer to not have the capital to purchase, right? So inherently, if there's too much supply and no buyers, you're probably dealing with lower real estate prices until you find those buyers who step up. So it's a possible theme to pay attention to here around the 41. We're still inside of this unchanged range. If we break to a new lower low, that's where it gets substantial. We talked spiders, energy, nothing to talk about here, sideways in the range. Let's talk about tech sector because it's the heaviest weight risk on sector. Pulling back, a little bit of that blow off top on the Thursday open via the gap up. However, plenty of room for a higher low still. I know it's like, when's this guy going to give it up about higher lows? When the higher low is no longer available. Look at this, right? How is this not from the highest high, a pullback, offer a higher low, continue the uptrend? Still in an uptrend. Looks like an uptrend to me. This is not a downtrend. We are moving from the lower left, upper right. So until a lower high has been cemented underneath here, and we talked about the NASDAQ head and shoulders, the S&P head and shoulders, break the neckline, maybe we start dealing with downside, and that's very possible, right? The market could certainly do something that looks like that. It's possible, but the base case as of right now is still that this is a pullback until proven otherwise in an overall uptrend. So moving along to SMH, I would echo similar sentiment. However, notice the indecisiveness of the doji right at that previous all-time high. I would prefer that SMH could just cool off in here. The difference there is that the SMH did not gap up on that Thursday session because, as we know, right, you got the ARM earnings, you got the Qualcomm earnings, QCOM there. You also had the LRCX, Lam Research, LRCX, I think. It's some combination of those letters. Those all moved lower, right? NVIDIA and AMD only moved higher based on the CapEx announcements from what we saw out of, who was it? My goodness. Oh, Microsoft and Meta. There we go. M squared, as we were calling them on the live show that following morning. So, semiconductors are dancing on the edge. I would think that a lower high here is a little bit more detrimental and probably signals more of a cool off to the market. Semiconductors led the rally in the upward direction. If they cool off, it probably means that the S&P 500 either seeks rotation into other sectors that might be interesting. Think discretionary probably. If the market's going to remain risk on, think financials, not breaking the neckline of the double top. If that happens, if discretionary and financials absolutely pick up the slack, then maybe the S&P goes more sideways and it's not a deep, dark pullback. But if discretionary fails, if financials fail, communications could probably get lumped into that category as well. And the SMH is breaking this or looking like this in general. This pullback here could be enough to cause the full retest of the all-time high on the S&P 500 or deeper to the ceasefire gap. Right, that would be down here towards about 264.75 in the SMH. That has to be a top watch. It's really the origin of this breakout in here. Okay, so your deepest pullback that I would pay attention to this week is probably around those lines, 264.75. Moving along to communications. What do we have over here? Already developing the head and shoulders look. There it is. There's your lower high on Thursday, failing to gap up over previous all-time high. So if it breaks the neckline, I would have to be in the bear camp here, right? You have highs, lower highs, equal lows. Right, this was a break, so this is now officially an equal low. It's not like a soft high or low combo. No, this is going to be a downtrend if we crack underneath 105.60, which would act as the first major sector to fall into a downtrend that's meaningful for the S&P, right? Obviously, the tech sector is not there yet. The XLF is not there yet. I guess the discretionary sector is there on the breakdown, right? So XLC, XLY are your critical ones. XLP, consumer staples, look really rough here towards the bottom end of the range. We have back-to-back inverted hammers. I wouldn't call it like, the end of the world, but it does not really imply the rotation is stepping up in a big way. Yeah, it didn't make these massive lower lows, but if we're thinking about a pure play rotational market, money should flow out of tech into consumer staples, and we should probably rotate to the top end of the range. We didn't really see that. So just something to carry forward there. Let's jump into our ratio grids. If you're not familiar with the ratio charts, you can feel free to check out the video tutorial on how to set these up. In the top right-hand corner, you can see that the tech sector remains the glue that is holding the market together. Financials don't look great. We know that the daily double top is also a concern. That's a red flag. Notice that the discretionary sector via the gap down did break for a lower low on the ratio chart. That is not a good sign. Communications trying to hold up in here, namely with your meta move in the upward direction. But is this a downtrend? The answer is yes. We now have lower highs and lower lows. So not all the way there. We do not have a full-blown risk on sentiment based on the sectors here. This is not quite flipping to risk off yet. This is getting close out of utilities. Utilities, the most bond-like sector, are the ones starting to signal, hey, getting a little bit dicey here. And we could see this as well in some of the specialized ratios. If we go to the A set, everything that's relative to tech is fine, right? If you look at this, this is still an uptrend. This, utilities, relative to tech, I should say, whenever we include utilities is what I probably should have said. You do have this triple top and lower low being brought in on the Friday session. So a little bit of a red flag here. Is that the end of the world? Well, I would still give this. Let's just take a look real quick together. Ooh, actually a close below. Eyeball test, I was thinking it was going to stay above. Let's go neutral here. Let's take a look at this. Definitely a double top, starting to slow down at least in terms of its trend strength. Let's go neutral on that. This is still looking good. ARC K, just a hair underneath. Just a hair underneath. We'll see if that ultimately does roll back over in the upward direction. I would still give this one the benefit of the doubt, noting the strength of the trend and distance over the upward sloping 50. For that reason, you might say, like, I don't know, is this also an upcheck then? Point being is we only have one thing here that's dramatically suggesting a risk-off rotation is going to be underway. It's not enough for me to fully change my tone to bearish, which is why I maintain that stance on the S&P 500 higher timeframes. Gold did get a little bit of an uptick here as the dollar absolutely fell off of a cliff on the labor report. The other thing to point out is that your bond ratio, TLT ratio to the S&P, did see an uptick here. It's that risk-off rotation we were talking about with the relative outperformance on the week. Not a shock there. It still isn't an overall downtrend, but bears would really like to see this break and hold over the daily 50 SMA if it's going to turn into something more. I do want to go to Bitcoin because it is looking like a beautiful opportunity. Oops, we want to flip this to a daily chart, please. There we go. Daily chart here is holding the breakout level right around that 112.275. I'm still in a swing trade on Bitcoin for anybody who's trying to keep tabs at home or whatever. We bought the breakout of the trend line in here. Still feeling okay about it. I really want to see this hold. Probably going to adjust stop to just below this. If it fails and comes back in, you know, not unreasonable for something that looks like that. So I just protect that and call it probably a small green trade if it does stop out. So anyways, right around this level here, if we can hold it, it still seems like a beautiful opportunity to offer a higher low. With that, let's go ahead and take a look at some additional things such as the dollar. Speaking of the devil, there's the breakdown on that Friday session. Here is the interest rate dropping precipitously on that Friday session. And all of this stems from what? The concept of the weak labor report, the massive revisions out there that probably signal the economy is not quite as strong as Jerome Powell was leading on to be in his press conference on Wednesday. This is the inverted ZT, which is the Fed tracker tool basically in terms of the 2-year yield. You can see it falling off here, which would imply that rates probably are going to, be forecast for a cut on the September meeting. Remember, there is no August meeting. What I do want to point out, and I don't think, because it's now Saturday, I don't think we can pull the data for one day ago. If we go to compare, yeah, the compare is one day ago is now thinking that it's Friday. So that's no good. It's going to be the same there and there. But on the Thursday session, I wish you could reset this a little bit. Maybe I'll try to find a screenshot online. On the Thursday session, the odds were about 70% of a pause. Now they're about 70, 80% almost for a cut of about 25 basis points. We can go to the probabilities tab and you can just see it a little bit more clearly. So again, Thursday, these odds were skewed over here about 70%, 70 some odd percent, if my memory serves me right. It's plus or minus 5, whatever. So market was pretty confident after what Powell said, oh, we're going to get another pause there. The data came out on Friday morning and immediately the odds shifted to about a 80% chance of a 25 basis point cut, which you can interpret two ways. You can interpret as the Fed didn't really tee up the cut, which is kind of odd because typically they do. Maybe there will be some henchmen that come out and start to signal that the cut is going to take place. The blackout period before September is quite a ways away. So Fed speak can probably influence that decision. Or the other way to take it is just that, oh my God, the Fed's going to have to panic here. That would be what? The bears want to see this chart come back into play. Let's go back over to Thinkorswim. We'll get back to the fundamentals in just a second. But the bears, they love this chart. Where is it? Let's go on over to the Fed funds rate versus the SPX. You can see if we align the red vertical lines, we start to get whenever the Fed cuts rates, markets get a pullback. Let's go over to the white crayon. Here you go. Fed cuts rates because, oh my God, it's not good. Fed cut rates, oh my God, it's not good. Pull back, pull back. This one, a little bit more mild. This one, a nothing burger. This is ahead of the dot-com bubble. So I would think that would maybe, in terms of comparison, you could have that. Here is the dot-com bubble actually forming, pain. Here is the great financial crisis, pain. Here is the sickness era, pain. We didn't really experience much of I think the comparison would be that this is similar to this, and then at some point in the future, right, if we get another red line here, maybe you would call it this one. I don't really think that's the case, but bears, of course, they love this chart. You'll probably start to see it floating around online. A Fed cut is a bearish thing, right? So be on the lookout for that. If we take a look at the actual data, let's go ahead and come into this. The actual report was very bearish because the expectation was higher than this, obviously. If you look over here, the expectation was 110,000, the actual figure 73,000. But the bigger issue was that the May and June numbers were revised in total by about 258,000 in the downward direction. Now, obviously, we know what the administration did. They had to fire somebody because it was fake data. But you have to remember that like labor data is very difficult to actually project and forecast and then collect in real time as well. So these things happen all the time. There's always revisions to the report. So we'll just take that as like a whatever. But the report revisions do show that there's more weakness than anticipated. Now, something that we can compare here is the layoffs and discharges rate, and that is going to be in gray here. So this gray line is pretty stable until the gray line actually breaks out and makes an advance. I say breakout. It's not a good thing if it breaks out. But until layoffs and discharges over about, what do we have? We're on the right axis here. Yes, right axis. Until we're over 600,000 on a regular basis, I don't think that you're going to have a big substantial issue in the labor market itself. We're sort of in this weird spot where, of course, companies are relying more on AI. They're not hiring as much, but the layoffs have not increased to a magnitude where, oh my goodness, nobody has a job anymore and there's going to be no consumer spending. So I think this is the thing that we need to tiptoe around just a little bit when it comes to parsing out the actual data. If we look deeper into the breakdown of the report, this is the current month down here, you could obviously see the rate of jobs added to the economy is falling off of a cliff. It's very, very weak here. However, where were the jobs lost? Government makes up a big segment of that. Professional and business services also makes up a big segment of that here. Those are typically going to be some higher earners, which is, I think, notable for what we see in the consumer in terms of spending, right? It's been kind of an odd situation where you go look at a chart of RCL, Royal Caribbean Cruise Lines, thing is up and to the right, going to the moon. Is that going to stop at some point? We shall see. The other one that I found a little bit interesting here is over in manufacturing, because the ISM manufacturing PMI report did come out on Friday, sort of confirming this, right? Indicating a slowdown in employment on the manufacturing side. One thing I do want to talk about as well is the beverage curve here. We talked about this a little bit with the group on Friday, but the point is this is a really weird beverage curve. Typically, the beverage curve is going to look like that on a standardized basis. The lower there are, or the lower number of job openings that there are, typically the higher the unemployment rate because nobody can go out and find a job. Well, as of right now, the job openings rate is moving lower, but look at unemployment. It's remaining pretty stable here, around at 4.1, 4.2 is what we just got on the Friday session. So this break in correlation just sort of indicates, once again, that the AI structural change in the unemployment market, but the labor market is clearly showing up as a real thing. Less jobs available because AI is replacing. However, people are not being let go yet. So that's why we see that move lower in the actual NFP. It's not, there's no big uptick there, but the actual unemployment rate seems to be pretty stable. So if you want an explanation, that's kind of what I'm seeing, at least in the data. Let's jump into what's on tap for this upcoming week. Then we'll look back at earnings here. ISM Services PMI is going to be the biggest information early in the week. That's Tuesday at 10 o'clock. This is probably going to move the market more so than the Friday ISM Manufacturing PMI. So be on the lookout for that 10 o'clock Tuesday morning. As we move forward, here's some Fed speak. Some Fed speak should be interesting post FOMC, post the labor report from Friday. Typical stuff, jobless claims on Thursday. That's really it. It's really all we have this week. Maybe, maybe a little bit of bond auction volatility here Wednesday at the 101 timeframe. The 30-year is usually a little bit quieter than the 10-year, but those would be your main events to keep tabs on. If we look at earnings insights, this is going to give us what we have so far. Keep in mind that we're still in a trough of earnings. So is it reasonable that the market, the market's always forward-looking. People say it forward looks by like 6 months or whatever on fundamental data. That's fine. The point is it reasonable that on an earnings contraction, right, we're going through a little bit of tumultuous of a time at the all-time high? I would think so, right? Until we come out of this and start looking forward even further, it does not seem unreasonable to me based on the way that this is taking place. Generally speaking, EPS year over year continues to move in the upward direction, but look at just the net gain here in the forecast for 2026. Much more meaningful than what we have here in terms of the move from 24 to 25 all up, and Q2 isn't even supposed to be that great based on estimates already. Now, we do have positive reports from all the Mag 7 names who have reported outside of maybe Tesla, which everybody anticipated the weak numbers from already, but let's look forward here. The upcoming week is going to be a big one. Really excited to see how Palantir reports. I want to get that out of the way. I'm actually pleased that this is Monday after the close, so the options chain can hopefully clear up for the remainder of the week. Palantir is a big one. Some people say hims and hers, honorable mention there maybe. AMD, an absolute monster as well. I'd like to watch that. I'm personally not interested in Supermicro. What else? Snap usually just follows Meta, so we'll see if that's going to be the case again. A couple of EVs in here, Lucid and Rivian, some of those smaller names. Not as interested in the upstarts, the Clovers. These are sort of like retail darlings of the world here. Open Door, not interested. Don't touch the shiny object. Uber, definitely worth watching. Shopify, worth watching there. AppLovin, not really thrilled about these guys in here. Novo, not interested. Maybe Disney, just to get a sense for the consumer a little bit. Six Flags could get lumped into that as well. Mickey D's, of course, gets a bit interesting there. What else? Fortinet, I'd love to watch just because of the theme. Cyber, of course. What else? Quantum, not interested in healthcare. I think that's probably it. Trade Desk, Rocket Lab. SoundHound's more of a pure play AI at this point. And that's probably all I'm looking at. Tempest AI. There we go. In real time. Those are my watches on the earnings calendar for this week. That's what we've got. With that said, let's jump back over to the platform here. Let's take a look at some more supporting evidence. Let's start with the bond relationships. The bond market does not seem overly concerned with inflation showing back up. If it was, this would be moving in the opposite direction, a move in the upside to break out through those equal highs. Not the case currently. Let's jump into credit spreads. Meaningful uptick here on those Friday sessions when the market sort of digested the labor report. This is a red flag. This is absolutely a red flag. If these develop into more firm uptrends, that's what bears want to see. It probably keeps the volatility elevated for the S&P 500. If we look at junk bonds in isolation, though, really not that bad of a session here. You can see that we just kind of moved into the range high, not even on the HYG. Notice that the LQD, which is corporate grade bonds, just made an equal high. So honestly, as we're trying to remain very objective about the data points, this actually is bullish. This is absolutely bullish for the market. Now, the only other counter argument could be that on a daily chart, right, the advance off of the April lows hardly made a new high over the previous all-time high. So, what is it worth that this is still over the balance range in there? That's the only argument on the very higher time frame divergence. But in the shorter time frame, that hourly chart, once again, looks kind of okay here, not breaking down underneath. So the short-term bullish divergence probably helps me identify that back over here on the S&P 500. It would not be unreasonable early in the week to attempt to close this gap overhead. That's the actionable takeaway there. Let's jump on into our, we already looked at Bitcoin. Let's jump into total breadth. This is what we were talking about when we were looking at market internal. So here's your deterioration on the moving average charts. Here's a little bit of a breakdown on new highs versus lows. I do think that's important, and it probably balances this out, again, to lean a little bit more on the bear side. If we look at the RSP, notice that this is over the top of its balance from back here, under the balance from back over here. That is noteworthy, in my opinion. So just on a relative basis, you would be looking at this all the way down here, equal weight-wise. If we jump into our QQQE, you can see the same thing here versus here above. So, breadth-wise, you're getting a contraction, which would make sense as the market pulls back. Let's jump into volatility. Big uptick. You're getting a little bit hairy over the 2050. I would think that, for what it's worth, the administration currently and the way that things sort of fly off the handle on social media, a 15 vol is pretty darn low for the current administration. It's not that it can't be there, but it just seems like, it's just asking for a little bit of an uptick. So not all that concerned about volatility. I think that it's kind of a little bit more comfortable up here, which opens things up for the trades. Actually, intraday, that would be good. If volatility could persist up here, at least it would give better opportunity on the intraday. If it really gets cranking up towards 40, I would be much more concerned. But volatility here is, I would think, a little bit more comfortable and nothing out of the ordinary given what we're dealing with. If we jump into the VVIX, not over the 120 handle, but you're in sort of like heads up zone, back over 103, that's worth talking about. And if you look at your vol futures, big contraction out of the contangos, but you're still in contangos except for very far out on the curve. Remember that this is 2, this is 3, 4, this is like 5 months out in terms of the way that actually is calculated. We could just go look on the actual curve itself. There we go. This is the backwardation that we're talking about. So I guess maybe, what did I say, 5? That's wrong. 1, 2, 3, 4. So 4 months out. 4 months out, towards the end of the year, you have a little bit of backwardation there. But generally, look at where this is, way up here. It's not even, it's like a small flash in the pan relative to everything else that we're dealing with. Even the 9 versus 30-day VIX stays positive here. The 1-day VIX not breaking out over that 2145. I think volatility has increased. Obviously, it would be a it'd be a foolish statement to say that it hasn't. But to a magnitude where, oh my God, I think that the market's going to fall out of bed and go to zero or experience anything like this, we're not close to this yet. Right? Could it develop to be that? Yeah, I mean, maybe. The market can always do whatever it wants. But as of right now, the signals to me are much more so aligned with the possibility of a weekly higher low. Just compare the difference back here, right? What were we? We were at like a weekly double top. Is this a weekly double top? The answer is no, right? So anyhow, that's that. Let's get into the core list of companies. A lot of gaps out here. So let's start with one without one. Close the upside gap. You can see NVIDIA closing the upside gap and then closing right at this level gives me a little bit of hesitation on it. I would still love to count this as a higher low. And like, let's be honest with ourselves. This is 2 days of pullback from a gap up to a brand new all-time high in a glaring uptrend. Oh my God, NVIDIA is going to crash and burn and go to zero. Like, get a grip. It's fine. Like, it's a little bit of volatility, a little bit of a pullback here. I'd be very curious to see basically if the 20 SMA supports. I don't know what the ideal trade is based on the way that the Friday session unfolded. It leaves a bit more to be desired than it does in terms of, so like more questions than answers out of this. Perhaps we get some kind of rotation back to the upside like this on a hold of 174. Do I want to be short into this low? Not really. The short probably is on a lower high Brigade bolt underneath 170-160 for a continued pullback, which would just reject the top end of this previous breakout from over here. NVIDIA, it's going to have to show me something pre-market on Monday for a clear plan to really develop. Let's go to Microsoft. Obviously on earnings, big break to the all-time high. Pull back. Almost the entire gap has faded here. It's still bullish. Don't get me wrong. This is a clear opportunity for a higher low, and this is clearly a higher high. So all things considered, buyers are in control. I would think that the attempt would just be a full gap fill reversal, looking to see if buyers step up there. If they don't, then I would just let this be, and I would continue to take the Kramer mindset, which is just own it, don't trade it. Own it, don't trade it. So Microsoft, I don't even think is worth looking at on the hourly. If we look at Apple, just smashed on earnings. It could not hold any of the gain, bearish engulfer here. I've been talking about this for a while. I'm not unique. I think a lot of people can see the opportunity just slipping through their fingertips in AI. They totally botched it, and I think the stock price reflects that. Nobody's interested. Nobody wants to trade it in here. There's no growth. They just closed a store in China. It's like not good. I would steer clear of Apple, but for the broad market, it's important. So if it moves lower, it's still the third heaviest weight company in the S&P. Move to the bottom end of the balance. First thought is, okay, balance rules tell us we should really be looking for buyers to step up here, and we should be looking for sellers to step up here, right? So it's still just in a balance. If it does test 193.75, who knows? It might set up a little bit of a long. Let's jump into Amazon, a gappy one. Big gap down here, excuse me. And you can see we're underneath this breakout point. So to me, this is more of a short contender. I would be looking for any rally rejections on Monday of 217.75, set lower highs, and target Friday's low. Beyond that, we're really looking at this set of lows and then the bottom of the major balance. If you do this, you can see it. There's your range. So this is kind of the primary idea I would be looking for. If we do get over 217.75, I would let this build out sort of cup and handle and then look for some kind of interaction into the earnings gap overhead. So 217.75 holds the secret for Amazon this week. Let's take a look at Google. Google gapping underneath this overhead supply. You could call this a double top. I like Google as a short underneath 190.150, underneath 189, looking for the breakdown sort of Brigade bolt, if you will. There we go. Get the words out. 180.75 would be that interesting downside target. Here it is, right? So I like the bearish consolidation. If it rallies and rejects, great. It's neckline retest. Here is your bearish Brigade bolt. If it just goes to the downside, this is thin structure. Absolutely thin structure down here. I'd like to see a hold under 189. Gets that breakdown, right? Next up, Metaverse. Big gap up, all-time highs. Take a look at the breakdown here. It's right to this previous pivot high. I'd be curious to see if buyers can step up here early on in the week. If they can't, next level 735.50. Next level, these highs at 726.75. The true gap closes all the way down at 708.25 from the Tuesday high, or Wednesday high, my apologies. Zooming into the hourly, you can see the rejection. You can see the downtrend developing. I think it's just, you have to watch 745.50. There's not really enough structure here built out yet. If we drop it, bears have a little bit of an edge for that gap close. If we could stay above and it looks like this, maybe an overshoot to then recapture is supportive over the previous all-time high, which would be noteworthy. So has to build out some structure, but 745.50 is the key watch as of now. Let's jump into Tesla. I really don't have much to say about this chart. I wish it looked a lot better. It unfortunately does not. You do have a little bit of a break of the trend line on the bottom side, but it's a lower wick. So still in range compression in my view. I don't like the daily chart. I don't like the daily setup. It's just in range compression in this box. You get the moving averages totally tangled up. There is no daily trend. I don't remember the last time I had a decent trade on Tesla. There was a little bit of a short in here. That was the day the options chain froze up, of course, the CBOE stuff. But aside from that, I don't remember the last major trade in Tesla where I was like, aha, the daily chart really made sense here. It was probably back in some of these breakouts, back in some of this. And ever since then, nothing in this zone over here. With that, let's jump into JP Morgan. Hammer on the daily. Would love to see the gap close overhead in a nice test of 296. That would offer a very nuanced higher low. I would just maintain a bullish stance, or even neutral to bullish in this box up here on JP Morgan. Remember, this just helps us gauge the S&P 500. If you look at Palantir, they do have earnings on Monday, so anything I can say can be blown out in an instant, basically. But the trend still looks fine on the daily. You have lows, higher lows happening here. Could this be a higher low at the daily 20? Absolutely. 150.50 is the number. If we're above that, excuse me, I would really carry forward that the all-time high is a weak reference point. Look at how equal all of these highs are. 1, 2, 3, 4 on the dot from that Thursday session. If we could Brigade bolt out of it, and again, earnings are going to throw this off, but if we're over 160.15, I'm still really interested in that opportunity because of the strength of the daily uptrend. Here is Broadcom. Let's take a look. You can see, again, you have your daily higher low, very similar to the Palantir chart, actually, with these higher lows riding the daily 20. If this is going to support and Brigade bolt back over 290.25, that's where the daily makes sense to me. On the hourly chart, you can see this as well. If this lower wick is going to be supportive, if these are buyers who are going to get follow through, you want to see this, or you want to see this for thin structure retracement from the Thursday breakdown over 294.50. Right, so Brigade Bolt would offer this in terms of risk reward, targeting the all-time high level here, up around 302.50. If it's going to be bearish, I would have to see price action here underneath 278.25. Let's take a look at AMD. Again, this is an earnings candidate, so anything I say can be blown out on Tuesday. For Monday, probably not trading it based on implied volatility on the options chain, but in terms of the outcomes here, I would think it's just got to be this, right? Intraday over 174, bulls in control. If we break underneath Friday's low, looking for the retest of this previous pivot high. Don't overcomplicate AMD here. This is a very clean chart. You have thin structure through the breakout. You have this little doji here. Keep it simple. Over 174 looks for this. Under 167.15 looks for this. And then this back in the upward direction like that. Okay, that is, again, ahead of earnings, perhaps. If you're a shares trader, options traders, please be careful with that IV. Let's take a look at Robinhood. Earnings out of the way. Really funky candle on that Friday session. If you look at the daily bar here, look at this doji. Massive indecision there. If we take a look at how it might unfold, probably thinking this is an opportunity over $100.75. If we're underneath, maybe a drift to the downside around 94.40s could be in play. That is Robinhood. And, probably might be a little bit more open-minded to Robinhood on the short side. Why do I say that? Look at the daily. You do have this lower high shelf already at 107. Upper wick rejecting the daily 20. It's not riding the daily 20 like what we saw out of Palantir, Broadcom, AMD, the whole 9 yards, right? So Robinhood could actually be more of that short side watch if this fails here, targeting the Friday low and then ultimately that 90.40. Interesting, right? Double top, lower high. I think that's the thing that we should index on over here on Hood. All right, let's get into these ideas. The first one's on a name that we hardly ever look at or trade, but GNRC, Generac. What do we have here? I was amazed at the relative strength post-earnings. Look at this big break in the upward direction, and look at the inside candle on Friday. Really, really impressive stuff here out of GNRC. So even if we don't want to trade it via options, because as we take a look, number one, there's no weeklies. Number two, the spread is terrible, and the volume is awful. So if you want to trade this with shares, you're really looking for a Brigade bolt up and over 195.50. And do we have an upside target mapped out? Is that all-time highs? No, it's not. Let's make sure we have a target mapped out from the daily. Let's grab a number of years here together, then we'll keep this thing moving. So that's your pivot high there. That aligns with these lows. This gap could possibly close, and this gap could possibly close. So just going to roughly sketch those in. This would, of course, go out to 50. You guys know the deal. Round numbers only. Round numbers only. We'll bring this thing down to 15. That's close enough. And let's just go back to the daily and see our upside there. So something that looks like this is a possible first target. And then if it does seek continuation, that's your next one overhead. All right. But anyways, this momentum bullish 3-bar play looks fantastic on Generac. All right, that is that ticker, GNRC. Coinbase is up next. A little bit more of a fan favorite here. Let's drop this thing down to a daily. Why don't we? Big gap down on earnings, of course, but look at where it's gapping down into. Take a look at this. I'd be really curious to see if this is going to act as support. So right around in this zone, we've got $313, $300.75. If we could support in here, I think it builds a compelling argument to get back into the gap. The way that you might trade this is if you take a look here, this, maybe inverted head and shoulders on the hourly is fine. That's one way you would want to be long here to test Friday's high. The other way is to just really take a patient approach and say, okay, here and here. Why is this an opportunity? Because Bitcoin is sitting at the major retest level as well that we've already talked about in today's episode. All right, so really paying attention to that out of Coinbase. Next one is going to be on Boeing. BA. Let's take a look at Boeing. I like let's go to the daily, the relative strength from Friday. Look at how it looks underneath the key level, previous pivot back here. Look at the lower wick, test the daily 50, and then where do we close? Back inside of the Thursday range. Boeing earnings are now in the rearview mirror. This breakout was sort of unsuccessful there, but if this is the pullback that it needed for a daily higher low, then is it possible that over the Friday high, you could at least retest the bottom end of the overhead range? I think so. So over 222.25 targets, 228.60 on Boeing, something that looks like this. Intraday. Let's go to the hourly. There it is. Over this high, Brigade bolt here, risk and reward to the upside, right? That is Boeing. Next up, OKLO, another retail darling over the last couple of weeks, months even. You could see here a very similar concept. Take a look at your hammer. Take a look at your previous pivot high back there. Is this just going to simply be a Brigade bolt in the upward direction? It very well could be. If you take a look at the hourly, you have a little bit of a gap to close overhead. Your key level, your key break is over 73.50. Moves back into the pivot high at 79. Do be cautious that this is definitely a range that you're trading back through, but I think it's tight enough risk reward where it would make sense to attempt this to align with that daily hold of the possible higher low, once again at 69.50. That is all I've got for you, as if that's all was nothing and light work here for a Saturday update video. We got monthly charts in there. We got a full recap of what my thoughts are in the S&P as this trend change is underway. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. We're live every morning at 8 o'clock Eastern, excuse me, and I'm coughing every morning at 8 o'clock Eastern time, so maybe do or do not come out to the show. In all seriousness. Live pre-market prep every morning, 8 o'clock Eastern time. All the links, resources, description, look down below. You can check anything out that's interesting to you down there. With that said, I think I'll send you off on the same note I always do. Have a green trading week, and I will see you in the next one.